As mentioned previously in my C-Corp video, all corporations are born as C-corporations under the tax code. Becoming an S-corporation requires an extra step called a tax election with vital tax implications. C and S corporations, the letters refer to subchapters of the Internal Revenue Code, are distinguished by how their income is reported and taxed. In all likelihood, you will qualify for S status with the IRS, but check these rules to make sure your small business corporation is eligible. The corporation is a U.S. corporation with no more than 100 shareholders. This eliminates public corporations. A husband and wife are considered one shareholder if they own their stock jointly. All shareholders are individual U.S. citizens or resident aliens, other S corporations, or an electing small business trust. The corporation has only one class of stock. There can't be any preferred classes of shares or other types of shares that give special privilege to some shareholders. All shareholders consent in writing to S corporation status by signing Form 2553. It must be filed with the IRS within 2 months and 15 days of the corporation's formation. If you miss the deadline, contact the IRS and ask permission to file late under Rep Proc 2013-30. An S corporation must file IRS Form 1120-S for every year of its existence, whether or not it has any income. For most, the tax year is a calendar year, so the return is due on March 15th. If your S corporation uses a different tax year, which they are rarely allowed to do, the return is due on the 15th day of the third month following the close of its tax year. You can get a 6-month extension by filing Form 7004, Application for Automatic Extension of Time to File Certain Business Income Tax Information and Other Returns. File it before the return's original due date. Most states recognize S corporation status, but state corporation tax rules may differ from the federal tax law. Typically, states impose a minimum annual corporate tax or franchise fee that applies to all corporations operating in their state. Some states also tax S corporation income or gross receipts. The bright side is that you can deduct any state and local taxes as business expenses on your federal corporate tax return. S corporation profits and losses flow through to shareholders, but the tax code adds a twist. Some items of S corporation income, losses, and deductions are separately stated on each shareholder's tax return. For instance, if an S corporation sells an asset at a gain and it qualifies for long-term capital gains treatment, this is a separately stated item. A shareholder gets capital gains tax treatment. And when the corporation elects Section 179, the Section 179 deduction flows through to each shareholder as a separately stated item. Typically, S corporation shareholders take profits either as wages or dividends. Either way, or even if all profits are kept in the S corporation bank account, the profits are reported on Form 1040 annually by each shareholder. An S corporation's operating losses flow through to individual shareholders. The loss can offset the shareholders' other income, lowering their tax bills. The operating loss is claimed on each shareholder's individual tax return, Form 1040. A shareholder cannot deduct a loss greater than his or her tax basis in the stock. Generally, a shareholder's initial tax basis is a total of money and property contributed plus a loan made by that individual to the corporation. So, for example, Jerry paid $5,000 for 100% of the stock in her S corporation, Jerry Co., when she incorporated. In its first year of operation, Jerry Co. lost $7,000, which was reported on its Form 1120-S corporate income tax form and on Jerry's Schedule K-1. Jerry can claim only $5,000 as a loss because this is the amount of her basis or investment in her S corporation stock. Important note here, Lending money to your S-corporation can increase your loss deduction. If a small business S-corporation needs more capital, the shareholder owners can lend money to it. A loan increases the shareholder lender's basis in his or her overall investment. So if the operation loses money, the shareholder lender's tax loss can also increase up to the amount of the loan. If the corporation makes money, the loan can simply be repaid to the shareholder. All shareholder loans must be properly documented. Social Security and Medicare taxes. For S and C corporation owner-employees, these are called payroll or employment taxes and are paid by the corporation to the IRS. For non-corporate business owners, these are called self-employment taxes and are paid quarterly along with their estimated tax deposits. This Social Security and Medicare tax is reported annually on Schedule SE filed with the business owner's individual tax returns. While salaries and bonuses paid by an S-corporation to employees are hit with employment taxes, corporate dividends are not subject to payroll or employment taxes. This presents a tax savings opportunity. If you work in your S-corporation, you must take reasonable compensation as salary. However, taking a combination of salary and dividends reduces an owner's Social Security and Medicare tax. Important note, it hasn't escaped the notice of the IRS that S-corporation owners minimize their employment taxes by taking dividends. If you're audited and the IRS claims your dividends were really wages taxed at 15.3%, you will have to show your salary was reasonable. One way to show this is to compare compensation paid to managers of similar businesses. As a rule of thumb, a 70-30 split should pass IRS audit, 70% wages, 30% dividends. There is a potential pitfall for S-corporation owners with a home office. Sole proprietors and single-member LLC owners claim all their business deductions, including the home office deduction, on Schedule C of their individual income tax returns. S-corporation owners, on the other hand, are considered employees of their corporation, so they cannot file a Schedule C. Instead, their home office expenses are classified as unreimbursed employee expenses for tax purposes and claimed on Schedule A. This means that home office expenses are subject to a restrictive floor on miscellaneous itemized deductions, and some are lost. And during 2018 through 2025, this deduction is no longer available for employees. But not to worry, there's a simple fix. The S-corporation should adopt an accountable plan to reimburse the S-corporation owner for the business use of his or her home. You must do this with a written corporate resolution and follow certain rules. So, for example, if 25% of the home is used for business, the S-corporation can pay 25% of the amount that would be allowable as a home office deduction under the home office rules. The S-corporation then takes the deduction and it isn't counted as income to the home business owner. This works whether the home is rented or owned. If you convert your existing C corporation to an S corporation, there may be some unpleasant tax consequences. Converting to an S corporation will produce a tax bill if the C corporation had passive income from investments, not business operations. Use the last in, first out, or LIFO method to report inventory. Had unrealized gains on assets of the C corporation, or sold appreciated assets that had not been held for at least 10 years after the conversion. S corporations in a nutshell. Small business corporations, including S corporations, are formed under state law. All corporations may elect S status by filing IRS Form 2553. S corporation status is often beneficial for startups because they frequently lose money in the first year or two, and shareholders usually can take the business losses on their tax returns. S corporations can't offer as many tax-advantaged fringe benefits as C corporations. Once elected, S-corporation status continues until revoked by shareholders holding more than 50% of the corporation's shares. If a corporation revokes S status, it cannot be reinstated for 5 years. Once S-corporation status is revoked, the corporation is taxed as a C-corporation. Dissolving an S-corporation often results in taxable gains or losses to the shareholders if any assets are distributed. Example: L, the only shareholders of ZZZ Inc., an S-corporation, decides to close up shop. After selling its inventory and paying its bills, ZZZ's remaining asset is a patent. The patent rights with a tax basis of $1 million are sold for $2 million. The $1 million gain is passed through to L and is taxed at a 20% capital gains rate, resulting in $200,000 income tax. The $2 million cash distributed to L could result in personal income tax too, depending on L's basis in his shares. L may owe state income taxes as well. It would be worse for L if ZZZ had been a C corporation. Then there would have been double taxation on the liquidation. First, the gain on the sale of the patent rights would be taxed to ZZZ at the corporate rate of 21%. Then L would be taxed at 20% on his gain from the corporate liquidation.